After a long period of dividend stocks being on massive sale, what we've been seeing recently is that a lot of companies in a handful of sectors have already fully recovered. For example, a handful of BDCs are now back to trading at what they used to be before interest rates soared. Looking at Hercules Capital, for example, right now you can see it's basically recovered from what it was back in 2021 before interest rates took off. Main Street Capital is another stock that's very close to being at where they were back in 2021, along with Hercules Capital. We've also seen companies in other sectors that have already seen a good recovery and thus aren't on a huge sale anymore. But dividend investors like myself are still waiting for other sectors of the market to recover, including REITs, energy stocks, and closed-end funds. All of these sectors are full of stocks that are largely still trading at sizable discounts right now, especially REITs, while interest rates still remain high. So in this video, I wanted to show people some of what I've been buying recently in the last couple weeks and how I'm perpetually picking up more shares of my favorite high-yielding investments. It's also another way for me to be more transparent with what I'm holding, although I share the latest news on every single transaction I make, including as soon as I enter or exit an investment over on our Patreon. But today I'll detail some of my most recent purchases and explain my reasoning for doing so. The first high-yielding investment I've been loading up on is the NEOS S&P 500 High Income ETF, ticker symbol SPYI. This ETF seeks to provide investors with high monthly income in a tax-efficient manner. On the fund's website, they outline 3 benefits that SPYI seeks to deliver. The first is distribute high monthly income generated from investing in the constituents of the S&P 500 index and implementing a data-driven call option strategy. Second, SPYI seeks to take advantage of tax loss harvesting opportunities in addition to utilizing SPX index options classified as Section 1256 contracts, which are subject to lower tax rates. The third is using a call option strategy, which may include both sold and purchased SPS index options, which may provide the opportunity for upside capture in rising equity markets. This ETF is a holding that I first bought into probably about 6 months ago now. I recently bought 21 more shares of SPYI at a price of $47.64 each. This holding is also one of my investments that I look to for income first and growth second. It's a monthly paying covered call fund that currently offers a yield exceeding 12%. I was really intrigued by its covered call strategy, which I think is much better than some other options that exist. SPYI is an actively managed fund, and the managers have used different methods of boosting returns depending on the market. One example is that they've used call spreads in the past, although they haven't done this in a while considering how the markets have been performing. Additionally, the dividends paid by this fund are more tax advantaged. According to this fund's prospectus, it says, the fund seeks tax-efficient returns by utilizing index options that receive favorable tax treatment under Internal Revenue Code rules because they qualify as Section 1256 contracts. Under these rules, each Section 1256 contract held by the fund at year-end is treated as if it were sold at fair market value on the last business day of the tax year. If the Section 1256 contracts produce capital gain or loss, gains or losses on the Section 1256 contracts open at the end of the year or terminate during the year and are treated as 60% long-term and 40% short-term, regardless of how long the contracts were held. In addition, the fund may seek to take advantage of tax loss harvesting opportunities by taking investment losses from certain equity and/or option positions to offset realized taxable gains on equities and/or options. With these things considered, I've been slowly building up a larger position in SPYI and I've been reinvesting the dividends I get. Since this ETF's inception, you can see it really hasn't gone anywhere yet in terms of share price. Another feature of SPYI is that it's less volatile than the overall market, which is good if you're looking for more stable income. It's definitely not an investment for everyone, especially if you are set on looking for more dividend growth. Although SPYI definitely hasn't been moving too much yet in terms of share price, I've definitely been more than willing to collect those 12% yielding, tax-advantaged monthly dividends. The next investment I've been continuing to load up on is Enbridge, ticker symbol ENB. They're a Canadian multinational pipeline and energy corporation headquartered in Calgary, Alberta. Enbridge owns and operates pipelines throughout Canada and the United States, transporting crude oil, natural gas, and natural gas liquids, and also generates renewable energy. The company operates through 4 different segments, which are liquid pipelines, natural gas transmission, gas utilities and storage, and also renewable energy. Following their acquisition of 3 U.S. utility companies in September of this year, Enbridge Gas is North America's largest natural gas utility. Enbridge Pipelines operates the world's longest and most complex liquids transportation system with about 17,809 miles of active pipe. Enbridge also continues to expand into green energy, as they're now one of Canada's largest green energy companies with 23 wind farms and 14 solar energy operations. I recently purchased 15 additional shares of Enbridge at a price of $33.80 per share. Their stock currently comes with a dividend yield of about 7.7%. What I like about this stock is their great dividend history. Although energy prices are cyclical, Enbridge has been able to deliver strong results through a variety of different energy markets. Their stock really does have a good dividend history, having raised their distributions every year for 28 years straight. Their compound annual growth rate since 2019 has been 5%, which is pretty good. They even have a very conservative payout ratio of 60 to 70% of their DCF. The company's targeting an average annual growth rate of 5% going into the future through their core businesses. According to the International Energy Agency, the demand for all forms of energy is going to continue to expand for decades to come, and Enbridge is involved in all of these energy types. Enbridge also has a long history of merging and acquiring companies, as well as developing new strategies for their energy businesses. In 2017, Enbridge merged with Spectra Energy for $28 billion, which increased the amount of gas the company has access to. They've also been pushing forward with this European offshore wind development segment. This global expansion, I think, is really going to help this company in generating new revenue sources, considering how there's a much bigger push for green energy in Europe compared to North America. But despite all this positive news and good results, ENB stock hasn't performed too well. Between late 2015 and late 2022, their stock has nearly flatlined, although they're still paying these generous dividends. When you look at the total return of their stock over this time with dividends being accounted for, then Enbridge has been a profitable investment. One thing is certain though, which is that despite the lackluster share price performance, the dividend safety and the growth have been really good. As I slowly keep buying into this stock, I am confident that we will see a rebound in the future. When that'll be, I don't know, but their finances and their dividend continue to remain strong. The next stock I've been buying into as it drops is Vici Properties, ticker symbol VICI. Vici Properties Inc. is an S&P 500 experiential real estate investment trust that owns one of the largest portfolios of market-leading gaming, hospitality, and entertainment destinations. Some of their properties include Caesars Palace Las Vegas, the MGM Grand, and the Venetian Resort Las Vegas. The company currently owns 92 experiential assets across a geographically diverse portfolio consisting of 54 gaming properties and 38 non-gaming experiential properties across the United States and Canada. Their portfolio is comprised of approximately 125 million square feet and features approximately 60,300 hotel rooms and approximately 500 restaurants, bars, nightclubs, and sportsbooks. I recently bought an additional 18 shares of this stock at a price of $28.49 each. Right now, Vici comes with a dividend yield of 5.71%, which is great for an equity REIT. This company right now is my second largest REIT holding in my portfolio. As someone who normally doesn't like to invest in experiential REITs, Vici stands out from all the others that exist. Even during a difficult economy and higher interest rates, this company continues to post really impressive numbers. Since their founding in 2017, this REIT has maintained a 100% occupancy rating across all their properties. They've also collected 100% of their rent due ever since their founding 6 years ago. Those two metrics alone are extremely impressive, but there's more going on with Vici that makes them exceptional. They're able to raise rent at a much faster rate than their competitors, and they have extremely long leases with their tenants. Their weighted average lease term remaining is currently 42 years, which is more than any other REIT I've come across. Their industry also has a very high barrier to entry, which makes it difficult for competitors to do what they're doing. Plus, they own some of the best real estate on the Las Vegas Strip. Caesars Palace, the Mandalay Bay, the Venetian, and all these others are Vici property tenants. It's very unlikely that after their leases expire that they're just going to pack up and move to a different building. This high-quality portfolio has also resulted in some amazing returns from a dividend perspective. Vici has a targeted 75% AFFO payout ratio, and you can see that since 2018 they've been able to grow their dividend every year. They actually had their largest dividend increase in the third quarter of 2020 during the pandemic, which was interesting. In September, the company announced another dividend increase to now 41.5 cents per share. This gives them a compound annualized dividend growth rate of 7.6%, which far exceeds a lot of other REITs like Agree Realty, Realty Income, and especially EPR Properties, which is another experiential REIT. Despite this company's continuous growth and consistency, Vici is still down over 8% for the year. For years it was going well until their share price growth paused because of high interest rates. Given their history though, their stock will continue to grow once conditions get better, so I'll just keep buying it while it's still on sale. So in summary, that's just a snapshot of what I've been buying over the last couple weeks. Although there has been a surge in the markets recently, there's still plenty of investments out there that are either still on sale or they're always attractive in my opinion. So with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.